The ugly truth about trading is this. Your worst enemy isn't the market, it's you. Every time you blow up an account, chase a candle, or double down on a losing position, you're not being betrayed by Wall Street or some hidden manipulation. You're being betrayed by your own psychology. And the darkest part? Most traders are their own executioners. They sabotage themselves long before the market finishes the job. Think about it. You've probably told yourself, if I just find the right system, I'll finally make it. Yet how many times have you switched strategies in the past year? RSI 1 week, Fibonacci the next, Wyckoff after that. It's not the system that fails, it's the trader running it. You, because every pattern, every setup, every so-called edge gets devoured the moment your fear spikes, your ego takes over, or your greed whispers, just one more lot, just a little bigger this time. Here's the paradox. The market itself is neutral. It doesn't care whether you win or lose. It has no bias, no memory, no agenda. But inside that neutrality lies a brutal mirror. Every trade reflects your hidden impulses, your impatience, your arrogance, your fear of missing out, your refusal to admit you're wrong. That's why 95% of traders lose. They think they're battling the market, when in reality they're shadow boxing with themselves. And here's the hook. In this journey, we're going to expose the 7 self-sabotage mistakes that quietly kill traders from the inside out. The mistakes no indicator can save you from. The mistakes that transform ambition into addiction, confidence into arrogance, and opportunity into ruin. If you've ever rage quit the market, blown up after a streak of wins, or stared at your screen whispering, "Why'd I keep doing this to myself?" This is for you. Because the real dark side of trading psychology isn't hidden in the charts. It's hidden in you. Next, we'll step into the first and most deceptive mistake, the one that blinds traders before they even place a single trade. Part 2. Self-sabotage mistake. The illusion of control, one of the most dangerous mistakes in trading. The first shadow you must confront is the illusion of control. It begins innocently enough. You buy a course, binge watch chart patterns on YouTube, memorize candlestick names like Doji, Hammer, or Shooting Star, and suddenly you feel like you've cracked the code. You think the market is a puzzle, and you're the genius who solved it. But here's the paradox. The more certain you feel, the more vulnerable you are. The market is not a puzzle. It's not a machine that rewards your IQ points. It's chaos disguised as order, randomness wrapped in structure. You don't control it. You never did. And the faster you admit this, the faster you stop torching your account in pursuit of an illusion. Jack Schwager's Market Wizards interviews hammer this truth relentlessly. The winners didn't become winners because they mastered control over the market. They became winners because they mastered control over themselves. They understood that trading is not about predicting every move, but about surviving the unexpected. One trader confessed, "I thought I was chasing setups, but I was really chasing certainty. And every time the market reminded me it doesn't owe me certainty, I lost big." Let's call it what it really is. Ego addiction. The illusion of control flatters your ego. It whispers, "You're smarter than the rest. You can see things others can't." But then reality slaps you. That perfect setup you bragged about, it failed. That guaranteed breakout, it reversed. And now you're left staring at a red position, moving your stop just a little lower, convincing yourself, "I'm still in control." No, you're not. The market is in control. You're just negotiating with your pride while your balance bleeds out. This is why amateurs repeat the same cycle: confidence, conviction, collapse. They believe that discipline is about controlling the market, when discipline is about controlling themselves. Real discipline is boring. It's setting a stop loss before you enter. It's risking 1% when your ego wants to risk 10%. It's admitting, "I don't know what happens next, but I know what I'll do if I'm wrong." That's not weakness. That's strength. Think about how absurd the illusion of control is. If you really controlled the market, would you be trading from your bedroom with a $2,000 account? If you really had mastery over price action, would you need to stare at charts for 10 hours a day? The truth is brutal. The market is 10 steps ahead of you. Always. The only thing you can control is your reaction. One trader Schwager interviewed started journaling, not just trades, but his emotions before, during, and after each position. He discovered a sickening pattern. Every time he felt most in control, disaster followed. His biggest losses came not when he was uncertain, but when he was overconfident. That realization changed everything. He stopped trying to control the market and started controlling his exposure. And that shift, from control fantasy to control reality, is what turned him profitable. So let's flip the mindset. Instead of saying, I need to control the market, say, I need to control my risk. Instead of asking, how can I predict the next move? Ask, how can I survive if I'm wrong? That's what pros do. They build systems that assume randomness, that expect failure, that guard against overconfidence. They don't need to control the market, because they've mastered controlling themselves. Here's the motivational truth. Freedom in trading comes the moment you stop clinging to control. The amateur thinks surrender is weakness. The pro knows surrender is power. When you stop demanding certainty, you stop forcing trades. When you stop forcing trades, you stop sabotaging yourself. You begin to flow with the market instead of fighting it. But be warned. This shift won't come easy. The illusion of control is seductive. It feeds your ego, strokes your pride, makes you feel like a wizard, until the margin call arrives. To break it, you need humility. You need to journal your lies. You need to see, in black and white, the places where you convinced yourself you were in charge when you weren't. The market will keep holding up the mirror. The question is, will you keep lying, or will you finally look? Because only when you shatter the illusion of control can you prepare for the next mistake, the one that lures traders into chasing every shiny opportunity until they bleed themselves dry. Part 3. The FOMO trap, fear of missing out. If the illusion of control is the first crack in your armor, then FOMO, the fear of missing out, is the blade that slips in and cuts you open. Every trader knows the feeling. The market explodes without you, candles surge like rockets, and suddenly you're sitting on the sidelines with sweaty palms whispering, I can't miss this one. That single thought has probably cost traders more money than any losing strategy ever invented. The cruel reality? FOMO isn't about the market. It's about your ego being terrified of being left behind. It's the child inside you screaming, what if everyone else gets rich and I don't? And so you jump in late, at the exact top, right before the reversal that wipes you out. If you want proof that the market is a mirror, look no further than your FOMO trades. They expose your desperation like nothing else. Schwager's interviews highlight this again and again. One trader admitted, I wasn't chasing setups, I was chasing validation. When I saw others making money, I couldn't stand not being in it. Another confessed, I realized my biggest drawdowns came not from bad analysis, but from boredom. I couldn't sit still, I had to click something. That's FOMO. Not a strategy, but an emotional itch demanding to be scratched. And here's the sarcasm you need to hear. You're not chasing opportunity. You're chasing ghosts. You think you're about to ride a trend, but what you're really doing is donating liquidity to the traders who entered earlier with discipline. They're selling to you. You're not joining the move. You're providing exit liquidity. Congratulations. You've just become the exit door. FOMO is brutal because it disguises itself as ambition. It whispers, don't be lazy. Don't miss the chance. Winners act fast. But in trading, speed kills. Discipline saves. The pros don't care about missing a move. They care about surviving long enough to catch the next one. Amateurs cry over missed profits. Professionals celebrate missed losses. So how do you kill FOMO before it kills you? Step 1. Redefine your scoreboard. Stop measuring success by how much I could have made if I entered earlier. That's a fantasy, not trading. Measure success by, did I follow my rules? A day where you missed a big rally but stuck to your system is a win. Why? Because it proves you're unshakable. Step 2. Weaponize boredom. FOMO thrives in idle time. So give your brain structure. Journal your impulses. Write down every urge to enter when no signal exists. Over time, you'll see the same patterns. Loneliness on weekends, jealousy after a friend posts gains, greed after a streak of wins. Once you map your triggers, you can disarm them. Step 3. Flip the perspective. Every time you feel the itch to chase, ask yourself, who's selling to me right now? Who's smarter on the other side of this trade? That one question will stop you cold. Because the answer is never dumb money. It's disciplined traders locking in profit, using your fear as their edge. The professor in me has to stress this. FOMO isn't solved with more indicators. It's solved with identity. You must choose to be the kind of trader who can sit still, who can watch rockets take off without you, who can say, if it's gone, it's gone. I'll wait for the next bus. Because the truth is, in trading there's always another bus. Always. The amateurs run across traffic chasing the last one. The pros wait calmly at the station. And here's the motivational punchline. Missing a trade is not the end of the world. But chasing one could be the end of your career. The faster you learn that, the faster you stop sabotaging yourself. But let's get dramatic, because as deadly as FOMO is, it's nothing compared to the next mistake. If FOMO lures you into bad trades, the refusal to cut losses chains you to them. And that mistake doesn't just bruise your account, it buries it. Part 4. The refusal to cut losses, the most expensive mistake in trading. If FOMO is the spark that sets you on fire, then refusing to cut losses is the gasoline that makes sure you burn to the ground. Nothing, absolutely nothing, has destroyed more trading accounts than this single mistake. We all know the story. You enter a trade with confidence, maybe even a little swagger. The setup looked perfect. Then it starts to drift against you. At first, it's only a little red. You tell yourself, it's just noise, it'll bounce. A few minutes later, it's deeper. Now you're bargaining with the screen. I'll give it just a little more room. By the time you stop rationalizing, your account is hemorrhaging, and what should have been a scratch loss has become a portfolio funeral. Jack Schwager's interviews are filled with traders who learned this lesson the hard way. One admitted losing $600,000 in a single afternoon because he refused to cut a loser. Another doubled down, convinced that the market has to come back, and watched months of gains evaporate in minutes. These weren't amateurs. These were people with skill. But skill is irrelevant when ego grabs the wheel. Why do traders cling to losers? Psychology gives us answers. It's called loss aversion. Studies show that losing feels twice as painful as winning feels good. Add anchoring bias. The tendency to fixate on your entry price as the truth, and you've got the perfect trap. You don't want to admit you were wrong. You don't want to feel the pain. So you deny reality and pray for reversal. But the market doesn't reward prayers. It rewards discipline. Here's the sarcasm you need. The phrase, I'll just hold a little longer, should be engraved on tombstones in the trader graveyard. That one sentence has buried more accounts than any bad strategy. Because in that moment, you're not trading anymore. You're gambling with hope as your only edge. The legends, by contrast, treat cutting losses as sacred ritual. Bruce Kovner said the worst thing that can happen to a new trader is to win big on their first trade, because it breeds the illusion that holding works. In truth, holding is death. Cutting is life. One trader literally taped a printout of his worst losing day to his monitor, not as torture but as discipline. Every time he felt tempted to give it more room, that reminder screamed back, this is what arrogance costs. Let's get practical. Cutting losses is not an art, it's a system. You predefine risk before you enter. You set a stop loss where the trade thesis is invalidated. And here's the kicker. You don't move it. Not just this once, not just a few more ticks. Never. Your stop is not negotiable. It's law. And if you can't obey your own law, the market will make you pay tuition again and again until you learn. Risk control is boring, yes. But boring is profitable. The pros risk 1 to 2% per trade, sometimes less. The amateurs risk 20% and call it confidence. The difference? One survives. The other writes bitter Reddit posts about manipulation and stop hunts. And here's the motivational truth. Refusing to cut losses is not strength. It's cowardice. It's the refusal to face reality. Cutting a trade proves you have the guts to admit you were wrong. Holding proves you're still a slave to ego. Which do you want to be? If you've blown up an account before, don't bury that memory, frame it. Keep it close. Let it remind you of the cost of denial. Because the fastest way to evolve as a trader is to stop repeating the same self-sabotage. And here's the irony. The day you finally learn to cut a loser quickly, you'll feel lighter. You'll feel stronger. You'll realize that what you feared wasn't losing money. It was losing your illusion of being right. And once that illusion dies, you're free. But freedom comes with another trap. Because after you finally cut losses and start trading with discipline, something dangerous lurks around the corner. Greed after success. The moment you string together a few wins, you'll feel invincible. And that's when the market sets its deadliest ambush. Part 5. Greed after winning streak, the hubris trap. There's a cruel joke in trading. Nothing kills faster than success. Not losing, winning. Because when you lose, at least you feel pain, and pain makes you cautious. But when you win, something far more dangerous happens. Your brain floods with dopamine. You feel chosen, untouchable. You think you've cracked the code. And then, quietly, greed slips in. Picture it. You've just nailed 3 trades in a row. Perfect entries. Smooth exits. Your P&L glows green like Christmas lights. Confidence soars. And then the fatal thought creeps in. This next one? I'm going bigger. That, right there, is the moment most traders die. In Market Wizards, Jack Schwager heard this theme again and again. Overconfidence kills more traders than fear ever could. And nothing feeds overconfidence like a winning streak. One legendary trader put it bluntly. The fastest way to end a winning streak is to bet like you deserve one. Another admitted, when I feel good, I get scared. That's when I know it's time to size down. But amateurs don't hear this wisdom. They hear the siren call of greed. They tell themselves, this is my hot hand. I'm on fire. If I just push a little harder, I'll multiply my account overnight. They think it's logic. It's not. It's the gambler's fallacy dressed up in trading jargon. And it ends the same way it does in Vegas, fast, bloody, and final. Here's the science. Winning trades trigger the same dopamine circuits as drugs or gambling. That's why it feels so good. But dopamine isn't your friend, it's your saboteur. It blinds you to risk. It shrinks your time horizon. It makes you trade survival for thrill. Suddenly, you're not trading charts, you're trading your biochemistry. And the sarcasm writes itself. You've spent months learning technical indicators, but the only indicator that mattered was your pulse rate. You thought you were trading momentum, but the only momentum was your ego accelerating toward a wall. Professionals flip the script. They know confidence is a double-edged sword, so they weaponize fear. After a win, they reduce size, not increase it. They assume the danger is highest when they feel safest. They understand that the job is not to get rich fast, but to stay in the game long enough to get rich slow. They don't trust euphoria. They distrust it. One trader Schwager interviewed had a bizarre rule. I size down after a win. Never after a loss. Counterintuitive? Absolutely. But brilliant. Because after a loss, your ego is bruised. You're cautious. After a win, your ego is bloated. You're reckless. That's when you need discipline most. Let's get practical. If you want to avoid the greed trap, set a hard cap on position size, no matter how many wins you've had. Write it into your plan like scripture. If your max risk is 1%, it stays 1% after 10 wins in a row. Another technique. Schedule a mandatory break after 3 consecutive wins. Walk away. Reset. Remind yourself you're not invincible. Because the second you feel invincible is the second you're most vulnerable. The motivational truth is this: big wins mean nothing if you can't keep them. What matters is not how much you make in one streak, but how much you keep over a lifetime. Greed doesn't build empires, consistency does. So let me hit you with the dramatic reality. Every trader dreams of the hot streak, but most don't survive it. They let greed seduce them into oversized trades, over-leveraged bets, reckless gambles. And the market, with cold precision, waits for that one oversized position to reverse, and takes everything back. If you've ever turned a winning week into a losing month, you know this pain. It wasn't the market that betrayed you. It was your ego, swollen with victory, that convinced you the rules no longer applied. But rules always apply, and the pros know it. So here's your challenge. When you feel unstoppable, stop yourself. When you want to bet bigger, bet smaller. When you want to double your size, have it. That's how you survive the hubris trap. That's how you keep what you've earned. Because the real danger isn't losing after losing. The real danger is losing after winning. Because that's when you give back not just money, but confidence, identity, and belief. And once greed humbles you, another shadow waits. Because when you're done chasing size, you'll be tempted by something else. Chasing systems. Copying strategies that don't fit you, believing someone else's holy grail will save you. That's the next sabotage, and it's every bit as deadly. Part 6. Copying other systems, the holy grail delusion. If greed after a winning streak is the hubris that blinds you, then copying other people's systems is the slow poison that rots you from within. Let's be brutally honest. How many times have you switched strategies in the past year? RSI this month, Fibonacci next, Wyckoff after that. One week you're scalping 5-minute charts, the next you're a swing trader. You're not trading. You're speed dating with systems, hoping one of them finally loves you back. And here's the truth Schwager uncovered in Market Wizards. There is no holy grail. None. The best traders in the world didn't share the same system. Some were technical junkies glued to tick charts. Others were intuitive macro thinkers holding positions for months. Some relied on pure price action. Others leaned on fundamentals. The common thread wasn't the system, it was alignment. Alignment between who they were and how they traded. The amateur refuses to hear this. They want to believe the problem is external. If I just find the right strategy, I'll finally be profitable. So they chase gurus, buy courses, subscribe to signal groups. Telegram pings, Discord alerts, Twitter threads promising 95% accuracy. And like moths to a flame, they dive in. But what happens? The system fails, not because it's garbage, though many are, but because it doesn't fit them. Think of it this way. Imagine borrowing shoes 2 sizes too small and trying to run a marathon. That's what happens when you force yourself into someone else's strategy. It's painful, awkward, and guaranteed to fail. Linda Raschke thrived as a fast-paced intraday trader. For her, long-term positions were psychological torture. Mark Ritchie built his fortune writing long-term trends. For him, intraday chaos was a nightmare. Neither was right or wrong. They were simply aligned, and this is where sarcasm is needed. If you think copying signals from a stranger on the internet will make you rich, I have a bridge to sell you. Even if the signals are legit, you won't execute them the same way. Why? Because you don't share their psychology. When they exit calmly, you'll panic. When they size rationally, you'll oversize. When they wait, you'll get bored and click early. It's not their system that fails. It's your inability to wear it without distortion. The professionals don't chase systems. They build edges. They reverse engineer their own psychology into a trading plan. They journal emotions, track comfort zones, measure where they feel flow versus where they feel panic. Then they tailor strategies around that. That's why their systems work, because their systems are theirs. Here's the motivational truth. You don't need someone else's edge. You need your own. Stop outsourcing responsibility. Stop blaming bad strategies. Start studying yourself. Your fear triggers. Your greed triggers. Your boredom triggers. That's where the real holy grail hides. Not in some guru's course, but in the data of your own behavior. Let's get practical. Step 1. Pick one approach and commit to it for 90 days. Journal every trade, every mistake, every impulse. Step 2. Measure not just profit and loss, but emotional alignment. Did this style make you anxious? Did it tempt you into overtrading? Or did it let you breathe? Step 3. Refine. Keep what fits, discard what doesn't. Slowly, painfully, you sculpt a strategy that matches your DNA. And here's the dramatic payoff. Once you stop chasing systems, you stop chasing illusions. You stop being a student begging for signals and start being a sovereign trader. The amateur keeps looking outside for salvation. The pro realizes the search was inward all along. Because the darkest sabotage of all is not FOMO, not greed, not even refusing to cut losses. It's the refusal to become yourself. It's trading forever as a copy, never as an original. That is the slowest, saddest death in this game. So if you've been hopping from guru to guru, ask yourself, when will you stop renting other people's edges and start owning your own? The answer to that question may decide whether you stay in the 95% or join the few who survive. And when you're ready to step into that truth, we come to the final part of this journey. The summary that ties all 7 mistakes into one brutal, liberating reality. Trading is not about the market at all. It's about you. Part 7. Conclusion. The dark side is you. So here we are, standing at the edge of the dark side of trading psychology. You've walked through 7 shadows, each one more destructive than the last. And if you've been honest with yourself, you've probably recognized at least one, maybe 2, maybe all of them, inside your own behavior. The first mistake was the illusion of control. You convinced yourself that the market bends to your intelligence, that with enough analysis you could predict every move. But the truth slapped you. You don't control the market. You never did. The only thing you can control is your reaction. Then came FOMO, the itch in your fingers every time you see a rocket candle take off without you. You told yourself you were chasing opportunity. In reality, you were chasing ghosts, providing liquidity to disciplined traders who were selling into your desperation. The third mistake cut even deeper, refusing to cut losses. This wasn't just about money. It was about ego. You couldn't bear to admit you were wrong, so you clung to losers until they buried you. And the market, like a merciless mirror, kept showing you the cost of pride. The fourth shadow was greed after winning streaks. Ironically, success made you weaker, not stronger. The dopamine high convinced you that rules no longer applied, that you were invincible. And that's exactly when the market pounced, reminding you that hubris is more fatal than fear. Then came the slow poison of copying others' systems. The holy grail chase. The telegram signals, the guru courses, the endless flip-flop between strategies. You thought you were learning. You weren't. You were outsourcing responsibility, refusing to face the hard work of discovering your own edge. And beneath all of this, every mistake had the same root: self-sabotage. Not the market, not manipulation, not algorithms. You. Here's the paradox. These mistakes are not curses. They're invitations. Each one is a mirror reflecting the parts of you that must die so a new trader can be born. Illusions of control must die. FOMO must die. Ego must die. Greed must die. Blind obedience to gurus must die. Only then can discipline, humility, patience, and authenticity take their place. That's why the legend Schwager interviewed didn't sound like gamblers. They sounded like monks. They weren't chasing magic. They were practicing ritual. They weren't trying to be right. They were trying to be consistent. They weren't clinging to outcomes. They were anchored to process. And in that process, they found freedom. Let's not sugarcoat it. Trading will hurt you. It will expose every insecurity you've tried to bury. It will humble you, humiliate you, and sometimes strip you down to nothing. But in that stripping lies transformation. Like a dojo, the market is training you, not in techniques of prediction, but in the art of identity. And this is the final truth. You don't rise to the level of your goals, you fall to the level of your identity. If your identity is built on illusions, you will collapse. If it's built on discipline, you will endure. So here's the challenge. Don't just nod along and say, good points. Pick one mistake you've seen in yourself. Journal it, study it, build rules around it, transform it. Because insights don't change your life, integration does. The dark side of trading psychology is not something you avoid. It's something you face, conquer, and integrate. And when you do, you stop being someone who trades and start becoming a trader. You stop chasing the market and start mastering yourself. You stop needing the Holy Grail, because you become your own edge. The market doesn't want you to win. Not until you become someone it cannot break. The question is, will you?